So today we're going to talk about something that has become more and more of a concern for many using AI to verify information, search for, life tips and these kinds of things. And what people are finding out is that you kind of have to double check AI because of accuracy concerns and things like that. So, and one thing that's behind a lot of the accuracy issues we're finding out here at IND is bias. What we did is we're testing some of the financial advice and we're noticing some bias in that. For example, we did a simulation where we searched for a guaranteed 5 to 6% returns with complete liquidity. And the options that we came up with were basically CDs, which aren't completely liquid, so that's kind of funny. AI maybe stepped in a little bit on that one too. But, treasury bills, again, and you've got issues with some of these compounding and things like that. So it didn't appear in this case that AI searched the very best options and spat them out. It was relying on some mainstream, what we're looking at to be biased. And so Barry, what did AI miss in that first question? 5 to 6% returns, completely liquid. Let's dive into that first one.
Yeah, the ultimate asset is what it missed, which is high cash value, properly structured whole life insurance. And the bias that AI has, it's pulling from traditional financial advice. As we go through several of these questions today that we asked AI about, those listening will see that it's very biased towards traditional financial advice. We want people to be aware, as you stated in the beginning, don't get your financial advice 100% from AI or any advice for that matter, because AI is still figuring things out. It's not completely accurate. We want to debunk some of the things that AI is telling people relative to financial advice.
Okay, so 5 to 6. If someone's saying, "Hey, I want 5 to 6% returns, completely liquid," they spat out some of the things that I shared. You're mentioning that they missed the ultimate asset. So, what should AI have delivered in terms of advice if AI was really unbiased and searching,
Well,
objective?
with liquidity, right, AI shouldn't have talked about CDs. I mean, CDs can be
Right.
locked up for 12 months or 60 months. And if you take the money out, you're going to lose the return. So are there fees and penalties if you surrender a CD early? Depends on the bank or credit union, but they're not generally liquid. With the ultimate asset cash value insurance, when the policy's growing cash value guaranteed, you're able to access the cash value within 30 days after starting a policy. It's liquid money. I tell people often, if you want guarantees, liquidity, and then a third option we'll get to here in just a few minutes, but if you want guarantees and liquidity, the ultimate asset of cash value insurance is remarkable because you're not locking up your money, nor do you have to worry about volatility. So AI completely missed it on this one. And even
Swing,
the answer that it gave wasn't an accurate answer.
swing and a miss from AI on that first question. Here's another one. We ran through the simulation. Show me investments that have never lost money in 150 plus years. Expected AI response, or the AI response that was conventional, no investment is guaranteed, talks about diversification, risk tolerance, all the things that you would expect to hear from a financial person, conventional financial person. So what did AI miss in that question?
Yeah, first of all, no investment is guaranteed. That isn't correct. We call the ultimate asset of cash value insurance a guaranteed investment. Remember, investment is when you put money into something and you get a return. So as the cash value is growing every year, it is guaranteed. The mutual insurance companies offer you a guaranteed rate of return. Steve, you know this as an estate attorney. This is a contractual guarantee, and then you earn a dividend on top of that. The dividend isn't guaranteed, but I like the question. in 150 years, because the mutual companies that we use, some of them are older than 150 years. They've been guaranteeing returns for 150 plus years. So big miss the AI failed to see. And it's
Yeah,
frustrating for us because we want AI to be more informative. It's
right.
really missing what banks, major corporations, and the wealthy are doing by having these cash value insurance policies in their portfolio.
Right. You want AI to be fair, you want it to be objective so people get the best information. And, who's programming the AI right now? Maybe there's a question in there. All right. So, um, let's see. And AI missed the actual track record of the contracts that you're talking about. You're right. I do love contracts. Contracts actually do create guarantees. That's the whole purpose of a contract, to have certainty, to have specificity, right? And what we're really talking about is we're talking about 7702 contracts that you can access. Anybody watching, the wealthy do it all the time. So that's one big miss by AI. All right, let's talk about another question. I have 500,000 in my 401k, but I need 50,000 for a business opportunity next month. What should I do? And you might expect the AI response, 401k loan if available. And that is an option. HELOC, personal loan. So they're all kind of obvious AI responses. The thing is, there are drawbacks with those. There's inflexibility, penalties, taxes, depending on what you're taking the money out for. What did AI miss? Barry, go.
Yeah, two things that I think of. One, in a 401k, you can take a $50,000 loan. But let's say you take a $30,000 loan. Do you know that you have to pay off the $30,000 loan before you can take another loan? So, although you can get up to a $50,000 loan in your 401k, any amount of loan under the 50,000 has to be paid off before you tap into more money. The other thing is, if you leave the job, you get fired, you quit, and you have an outstanding 401k loan, that loan has to be paid off before your next taxes are due. So if you take a loan, let's say December of 2025, you leave your job, you got to pay that loan off before April 15th of 2026. So there are restrictions. What AI missed is that cash value life insurance loans are accessible up to about 95% of your cash value. And if you take a loan for less than 50,000, let's say you've got $300,000, in this case they're saying 500,000, so let's say you've got $500,000 in cash value in your policy, and you take a $50,000 loan or a $40,000 loan, you can keep taking more loans up to 95% of your $500,000 cash value. If you quit a job or leave a job, the insurance company doesn't care. They're not going to call you and say, hey, we heard that you left your job. You have to pay this loan off within the next 3 months or 6 months. No, the life insurance company is using your death benefit as collateral. So you can pay the loan off however you want and whenever you want. And you're not limited just to the 50,000. I would have appreciated seeing AI talk about, hey, there's this other asset out there called
Right.
a policy loan besides your 401k loan, but it completely missed it.
Right. For the critical thinkers out there, even if you thought that AI should have maybe concluded that many people may not have this asset, the fact of the matter is that if AI was being completely objective, they would have said, "Oh, and if you do have this asset, you should go to this one first." Right? If AI knew of this asset and this strategy, then AI could have at least suggested that this is a better way to take loans, more flexible on repayment. When you pay it back, that money becomes freed up, like you said, for additional needs. You don't have the consequences and no tax hit or anything like that. So, in addition to freedom on the amounts, but
Yeah, and Steve, to be fair, the question was, I have 500,000 in my 401k. I need 50,000. So it should have just given 401k answers, but it didn't. AI gave HELOC answers, it gave personal loan answers. Well, why didn't it give cash value insurance answers? Because if you look at historical figures, Walt Disney, Ray Kroc, others, they've used their whole life policy to take loans to invest in business or
Right.
opportunity. So AI did talk about HELOCs and personal loans. It should have also included cash value insurance loans because they're legit. I mean,
Yeah, I
people
mean,
have used loans for decades.
if AI was nimble, like it's like kind of built to be, it would have pivoted and said, look, if you do have this asset, you should do it instead, right? It did that with the HELOC thing. I mean, it did
Yeah.
that. So it should have pivoted toward the ultimate asset, cash value life insurance, just in the same way that it pivoted toward the HELOC, but it couldn't do it because it's biased toward those other areas. Okay, next question. How can I access my retirement money at age 45 without penalties? This gets to one of our favorite topics, which is, retirement, tax-free retirement, tax buckets in retirement. Barry, go. I just know you're chomping at the bit to.
Well, and AI's response is, a Roth IRA. But the
Right.
problem with the Roth, you still have a 59 and a half early withdrawal penalty. So that isn't a good answer. It also came up with a SEP,
Right.
or a hardship. Like if we're not asking AI if there's a hardship. We're saying, I've got this qualified money. How do I access it at the age of 45 without a penalty? And frankly, you can't. You can't get to qualified money until you're 59 and a half. There are exceptions for the age of 55, but not 45. So had AI been unbiased, AI could have suggested once again, there is an asset that allows you to access cash before 59 and a half, in this case, age 45, no 10% penalty, right? That's an early withdrawal. No tax either. If you take money out of your qualified plan, I don't care if it's a SEP or a 401k, a TSP, a 403b, you're going to have to pay the tax. The only exception is the Roth if you wait until you're 59 and a half or older. So even taxes will be due on Roth money, Steve, if you're taking it out before 59 and a half. So a lot of people think, oh, I've got a Roth IRA, I'm home free. I always will have tax-free money. No, it's only if you access that money after 59 and a half.
Yeah. So the bias revealed really locked this question. They were really locked. AI is really locked into the 401ks, and they seem to be grasping to try to figure out some other way that someone might plan for retirement. Which actually we
Yeah.
talk about it all the time. That this is a completely independent aspect of the retirement strategy. If anybody's listening, thinking, "Well, what are you guys talking about?" This is a completely different component to retirement that creates a bunch of benefits, flexibility from a tax standpoint, the ability to ride out if you have a downturn in your 401k fund, that you don't have to just start withdrawing like mad and deplete so you have an option to kind of offset that. Obviously AI did not step into the shoes of a trusted advisor on this one. So
And Steve, I want to say one more thing. Let's run like three scenarios. Scenario number one, let's say you walk into a bank and you say, hey, I want to invest money. Scenario number two, you go to your employer and say, hey, how can I save for retirement? Um, and option three would be you talk to your financial advisor. Where can I save and invest money? All three of those responses are going to be qualified plans, stock market based. Not any one of those is going to suggest cash value life insurance, right? You're not going to go to your employer. They're going to enroll you in a 401k. They're not going to tell you put money into a cash value whole life insurance policy. You walk into your bank today and say, hey, I've got $100,000. I want to invest it. You're not going to hear about cash value insurance. And it's a little disconcerting because you're getting guarantees, you're getting liquidity, and we're going to get to this third benefit here in a minute. But why wouldn't that be talked about? We want those things. We want guarantees. We want liquidity. AI doesn't believe it's out there. which is pretty frustrating.
Yeah.
We all want these things. Why aren't we being taught or told these particular things with cash value insurance?
I will say this, if you're a high earner and you've got company owners that are in the know, they may have brought this up because this is something that can be very useful for executives, much more so than the conventional planning. So if you're listening going, well, why wouldn't somebody tell me that? Well, if you're in the know, if you got people that are innovative that want to give you things outside of the box that are very helpful, then you probably did hear about it. But moving on to the next question. So this one's huge, by the way. To me, this one's huge. We're talking about, we ask AI, what asset class do major banks hold over 130 billion for in their own reserves? Boom, expected response, well, and I shouldn't even say expected. I would have expected AI to pick this one up. Government bonds, cash reserves, real estate. What did AI miss? Bank-owned life insurance. You go to the balance sheet of any bank, you're going to see huge blocks of this, BOLI asset on their books. So obviously AI couldn't read the financial. You didn't like search, the financial statements of banks to come up with an easy one. This one we threw a bone to AI, I feel like, and
Yeah, this was definitely a softball.
yeah,
But maybe it also shows us how deeply buried this information is within the banking system, in their balance sheets, in the FDIC website. You've really got to struggle to find this information with Wells Fargo, JP Morgan Chase, US Bank. All these banks are holding billions and billions of dollars worth of cash value insurance. AI didn't find it. We know it's there. We expose it. I expose it in my book here, Live Rich, Die Rich. We expose it in our videos and podcasts.
yep,
So this was a huge softball that we threw AI, didn't even come up.
yeah, which
And
really
again,
reveals.
it's very disappointing.
Yep, really reveals the bias in that particular case because it wasn't even a nuanced sort of advisor kind of thing. It was more like just flat out information that AI could have found and
And
didn't find it.
yeah, and Steve, this revelation, if it's good enough for banks, what why is it not good enough for us, right? Why isn't it being talked about more? And when you go to your bank, the three scenarios I gave earlier, when you walk into the bank and you say, hey, I'm looking for an investment, I want something that's guaranteed, I want something that's liquid, and they're not telling you about cash value insurance, but that very bank owns billions of dollars worth of cash value insurance, there's a huge disconnect, right? They're saying one thing on one hand and doing another thing on the other hand, and they're not telling you what they're doing.
Right, which isn't really.
It's very frustrating when
Yeah,
you see that banks are operating differently than what they're giving you advice for.
right. It's frustrating. It's not entirely surprising. It seems like a lot of times people that are in the privileged position kind of keep those details to themselves, but I digress. So let's get into the next AI question. This one relates to what we call sequence of returns. We talk about this a lot on the channel. Sequence of returns has to do with conventional retirement and the fluctuations that happen with retirement, regular market-based retirement accounts. The market tanks at the wrong time, and somebody has to kind of figure that out. Retirement. So we asked AI, I'm retiring in 2008 with 1 million in stocks. What's my withdrawal strategy? AI responded, lower your withdrawal rate, wait for recovery, rebalance portfolio. Barry, you were in the conventional retirement space, the conventional financial space. You saw this, you saw you got the feedback from your colleagues. Hey, just tell them to stay in it for the long haul. If you're retiring, obviously that advice kind of falls flat. So what did AI miss in that retirement planning question?
Yeah. If you're going to take a lower withdrawal rate, that means you're accessing less of the $1 million. It means you've got less income. And I recently did a video on this. People can go to the Insurance and Estates website where I talked about adding 30 to 50% more spendable income in retirement. There's a way to do that. What AI missed is generally speaking, people are going to withdraw like 4%, the Monte Carlo formula. But AI is saying, no, you might have to withdraw less money. You might have to rebalance the portfolio, etc. Well, when you retire, you might wind up with less money, but you don't want less money. People want to retire with more money, if possible. But yeah, AI missed this big because there are alternatives with two things. One we've talked about already, the cash value whole life insurance allows you a buffer. We call it a volatility buffer. That
Right.
if the market is down, why would you be taking money out of your negative stock market portfolio? Now you're adding double pain, right? The market's down, you've lost money. Now you're taking out more money for income. That's just double the pain. So we're saying if you have cash value insurance, take income from that, let the market come back in your portfolio, then start taking income. So we love the volatility buffer. But the second thing is an annuity, a guaranteed lifetime income annuity. When someone's approaching retirement, we say shift some of that market-based money into a guaranteed lifetime income annuity. So you know that there is a portion of income that's coming to you that is guaranteed. Doesn't matter what's happening in the market or the economy. You've got money hitting your mailbox, hitting your direct deposit bank account month in and month out with that amount of money. That's an awesome way to go for a portion of your portfolio. And then combining it with the life insurance for the volatility buffer. This is how we show people you can get 30 to 50% more spendable income in retirement. Don't rely just on your market-based money, because according to AI, you'll have to have a lower withdrawal rate. You got to wait for recovery,
Yeah.
rebalance the portfolio. Well, what if you need the money? Those aren't good plans if you need the money.
Yeah, I'll paraphrase. That's a loser plan that AI is actually recommending right there. I mean, I don't think you have to think too hard to realize it's a loser plan. Um, so, and I'm glad you mentioned volatility buffer. I'm glad you mentioned annuities, Barry. When I was practicing in trust and estates, when I was doing a lot of practice, it was pretty regular for annuities. Annuities were getting bashed for different reasons. But if somebody's got that in their mind and they're not looking at annuities in a modern context, they should, because annuities have become much more, advantageous. They function like a pension. They provide guaranteed income, which is a bucket that a lot of people want in retirement. A lot of nice things going on with those, so encourage it in addition to everything else. Yeah, AI didn't get into that either, into the annuities. All right, well, let's go to this one. Why don't financial advisors recommend whole life insurance? Expected AI response, high fees, low returns, term and invest is better. All the things that probably the people that are pushing, market-based kinds of things are feeding into the system, right? So we expect to hear that. What AI won't say is that advisors can't charge ongoing fees in life insurance. That's an interesting one. So people worry about fees. That's one issue. But what else did AI miss, Bear?
Yeah. And I'll back up one step. Why don't financial advisors recommend whole life insurance? It comes down to money. And you often will say, follow the dollars. Why does a advisor recommend buy
Yeah.
term insurance and invest the difference? Or, hey, I want true diversification. Okay, get this ETF, get this mutual fund, get these stocks, right? That's not true diversification because all the money's still in the market. So
Right.
financial advisors, they earn fees. It's called AUM, assets under management. The more money they have under management, the larger volume of fees they're going to earn. So 1%, if they're charging 1% on a $10 million AUM, they're going to earn less than if they were earning 1% on 100 million or a billion of AUM. So they're trying to accumulate
Yeah.
as much in their AUM bucket as possible because they want to continue to earn the fee off a larger volume of money. And get this, every dollar that people put into whole life insurance is a dollar they're not earning fees off of.
Right.
And if we run the numbers, this is just a general idea. People will say, oh, whole life insurance is expensive, it's high fees. What's true is there is a larger commission paid in the first year, not necessarily on the policies that we sell, because we do properly structured policies where we reduce death benefit, we reduce fees and build cash value. But there is a commission paid in the first year. But years 2 forward, not much in commission is paid out. If
Right.
we look at a side-by-side comparison, someone with a market-based account is going to pay 8 to 10 times more in fees through their lifetime as compared to them having a whole life policy. So high fees is ridiculous because over someone's lifetime, they're going to pay high fees in a AUM account with a financial advisor. And look, this isn't our opinion. We've done the math on this. We've heard from guys like Jack Bogle at Vanguard, Frontline, 60 Minutes, Bloomberg. I mean, everyone's talking about this, that if you have just a 1 or 2% fee, it can erode 30 to 50% of your portfolio over someone's lifetime. And you think, well, it's only a 1 or 2% fee. It
Yeah.
might seem like that at face value, but over time,
Yeah.
that erosion is dramatic. And you're going to wind up with 30 to 50% less money, and it's taxable money. We're saying pay less fees in properly structured whole life insurance, the ultimate asset, and have money come to you tax-free. That's the third point I wanted to make.
Hey, that's a good
That
point.
guarantees liquidity and tax-free use of money.
That's a good point. And I can be a bit of a contrarian when it comes to AI. So I'm actually kind of enjoying this episode. I think this one is a tell, right? AI says all the stuff that basically the advisors are pushing, and without, in a very myopic sense. In other words, um, staying very conventional. I think I had a thought, may have gone out of my head, but
And Steve, you're right.
yeah.
What we're seeing here in this podcast is regurgitated financial advice. So that's what AI is doing. AI is just
Right.
regurgitating everything you're going to hear from a financial advisor or Wall Street. This is the bias. We need to change the narrative. We need to change the output of what AI is given, because right now it's extremely biased towards traditional financial services.
Yeah, so bias detected. So we're going to move on to how do we asked AI, how do generationally wealthy families actually structure their money? Once again, we got, trust, which is kind of a no-brainer, diversified portfolios, family offices. Again, this is a big one also. Maybe we could give AI a pass because they don't know what wealthy families are doing. I mean, I'm trying to figure out how AI missed this one. But what's your take on that, Barry?
Yeah, the diversified portfolios, again, true diversification is not one asset class and just buying more investments in that asset class, like the ETFs, stocks, mutual funds, etc. A diversified portfolio is going to consist of stocks, bonds, mutual funds, ETFs, right? That's a part of it. But you're also going to have real estate, gold and silver, crypto, a business, maybe commodities, and the ultimate asset, cash value life insurance. See,
Right.
in that circle, you look at the pie and you say, okay, I've got this slice of pie, etc. And cash is involved in there too. True diversification, you want to make sure that you're protected against all sorts of different things, market swings, economic issues, job losses, etc. I know people that had job losses, that had hundreds of thousands of dollars in their cash value insurance policy that they were able to use to get through those job losses. I also know people that lost a ton of money in the market and their portfolio's down, but they want cash for opportunity. They take loans from their cash value policy, because when the market's down, your cash value life insurance policy is still growing. Anyway, that's my take on the diversification.
Yeah.
That's okay.
Well, we talk a lot about the Rockefeller legacy and how they used the ultimate asset in the generational to bridge the generational gap and to keep wealth flowing from one generation to the next. So it's kind of, maybe we should try to send that to AI. Is there any way we can do that so they can update their knowledge base on that?
Yeah,
Uh, all right.
and you
So
nailed it. Yeah, you nailed it. That for generational wealth, like the Rockefellers and many others, you don't have to be a Rockefeller and have billions of dollars of assets. You can have hundreds of thousands in assets, and you can use cash value insurance, and that death benefit in most cases is going to pass to your beneficiaries or to the trust tax free. That's a phenomenal wealth building generational legacy tool because it's a guarantee. Like if I said to you, hey, you've got an option. You can buy term insurance and maybe it's a lower premium right now. It'll get more expensive as you get older. Or you can buy whole life insurance and your term insurance, it's going to go away. Probably around the age of 65, it's going to go away. You could keep paying for it maybe through 85, but it gets really expensive. But what if you live to 90? Then what? Or would you rather just have whole life insurance that's a guaranteed payout? See, I think most people, if they really saw the side by side comparison, they would want to go the whole life route because of the guarantee. When you're purchasing life insurance, even term insurance, you're doing that because you're saying, if I die or when I die, there's going to be something that goes to my family. Well, why not keep that same thinking your entire life? And whole life provides that. Doesn't matter when you pass away. I love the
yeah.
permanence of whole life insurance. So generational planning. Yeah, how do generational wealthy families actually structure their money? AI completely missed life insurance.
Right, right. And that was my point in bringing up, the Rockefellers as an example. And you're right. You don't have to be billionaires. You can to have some assets and have some funds, and you want to pass them in a way that actually preserves the wealth, which is really the point behind the strategy. So, Jason Kenyon, who's part of I&E, who likes to stay in his bunker behind the scenes, has actually run a lot of stuff through AI on this to try to correct AI and test AI. And he actually said, like, what about this and what about that? And it was like, it's kind of funny. He's written some articles about it that are on the website, InsuranceandEstates.com. But AI actually said, oh my goodness, I was wrong. I can't believe it. It's funny he's having these conversations with AI. So to all the points that we've been talking about so far, you can kind of try to educate AI, but missing a lot of the keys here. So we're going to keep it moving. How do I legally pay zero taxes on investment growth? This is another great example. You already mentioned the Roth, Barry mentioned, I think we initially mentioned bonds and these kinds of things, like municipal bonds would be a tax, haven. What did AI miss on this question?
Yeah, and AI did talk about Roth and some municipal bonds. But yeah, AI again missed life insurance.
Yeah.
Like life insurance is one of the most powerful tools out there. And you as an estate attorney know this. But if we surveyed 100 estate attorneys, Steve, how many of them are going to say, yes, whole life insurance is one of the greatest ways to pass on tax-free money to your family? Like the vast majority of them are going to agree with that, correct?
Right. As far as a broad strategy, life insurance, death benefit, yeah, tax free.
Yeah. Yeah. And there's something out there called an ILIT, irrevocable life insurance trust. If you have assets beyond the estate tax exemption and you die, your family has to pay estate tax on any asset above the exemption. Right now, I think it's like 25 million per
Right.
couple,
And
right?
that's
Somewhere in there. And
that's
it's changing every year. But what
right.
if you've got an estate worth 30 million, 50 million, or 100 million, If you don't have life insurance to pay the estate tax, which is about 50%, I'm just going to use that as a general number right now, your family might have to liquidate assets or use cash that you may not want them to use. Having an irrevocable life insurance trust, now you can use the life insurance policy to pay the estate tax. And it
Yeah.
actually removes assets out of your own portfolio.
Right.
So there are ways to do this, but life insurance is remarkable when it comes to legally paying zero taxes on investment growth. This is a way that you can do it with generational wealth, but also your cash value in a life insurance policy, if done correctly, comes to you tax free. So let's say over time, you put $1 million into your cash value life insurance policy. And this is what AI missed. And let's say that $1 million that you put in has grown to 4 million in cash value. You can take 4 million out of your cash value insurance policy, 100% tax free, never pay it back. That would come off of the death benefit when you pass away. That is tax free retirement planning at its finest.
Yeah.
And this is why we call cash value insurance the ultimate asset. As you've listened today, you're hearing that cash value insurance is doing multiple things at the same time, right? It's checking all these boxes. Well, how would you like tax-free money that you don't have to pay back in your retirement that is guaranteed, liquid, and you've got this death benefit that can take care of legacy planning too?
Yeah. If you're a high net worth person, you're listening, feel free to ask us about the whole islet thing. The thing about islets is that they basically let you scatter the seed outside of your estate. So you could take your $1 million, put it in an islet. You just moved it. You gifted it. You used part of your exemption to get that money out, put it into this islet. And whatever happens from there is outside of your estate, which is actually very powerful. So like you said, Barry, the $4 million that is death benefit, all that tax, it's outside of the estate. And we've seen high asset people. I think maybe one of the more recent ones would have been Ozzy Osbourne, massive estate. And think about what they could have done with trust planning. A lot of them didn't do any trust planning whatsoever. So we're going to hit the last question here. This is the meta question. If you're giving me unbiased financial advice, why do all of your recommendations benefit the same institutions? This was the question posed to AI, by the way. So in other words, I think this is classic Jason trying to test AI. And AI, the expected response was that AI might deny the bias, best practices. Um,
Hmm. And
and
isn't that interesting?
it did try to kind of say best practices and stuff. So
Yeah,
what did this
yeah.
expose, Barry? Yeah.
Yeah, I mean it's uncomfortable for me to hear, oh, these are best practices. Like the answers that AI is giving, it's not best practices. Maybe in some scenarios, some of this advice is okay, but AI came back with these are best practices. If you look at what the wealthy do, business owners, banks, corporations, they're not doing this. They're not following these best practices. They're doing something different. They're doing something contrarian. Why? The number one reason, Steve, I want people to grasp, the ultimate asset gives you control. Control. That's what the wealthy want. Banks want control. When you put money in the market, you're out of control, right? In other words, you're not sitting on the board of the company whose stock you're investing in. If you have money in mutual funds, you're not talking to the money manager over the mutual fund. You're either in or you're out. And we're not saying don't ever invest in the market. I've got market-based money, but I don't have qualified money. I've got a brokerage account. I choose the stocks. I follow it. I invest how I want to invest. But the ultimate asset of cash value insurance, because it's guaranteed, it's a guaranteed investment, you're in control. You want to take policy loans? Great. Take them when you want. You want to pay the loans back however you want? Great. You're in control. And we want people to recognize that AI completely missed that these assets of cash value insurance and all the benefits we're discussing today, they give you control. And unfortunately, AI is so biased down the traditional financial advice, this stuff wasn't even considered.
Yes, I think the takeaway for you guys watching is AI has biases. AI misses things. One of the things that I think a lot of the people in the know are saying is you got to hold AI accountable, keep it honest. People go to AI for advice all the time now, and whether it's personal, relationship advice, financial, and recognize that AI is programmed. And so you can't expect to have an experience where you're talking to someone that's extremely in the know about a certain thing and very insightful and able to give you advice that isn't necessarily conventionally spoon fed. So something to keep in mind. Really glad that you guys joined us, Barry, as always. Great thoughts. And you mentioned your video, your other video. That will be on the channel as well. You mentioned that that's on the website. So you guys can look for other topics on the channel. And we also have a lot of articles and things on the website. So feel free to reach out, comment. And with that, I appreciate you guys joining us today, and we'll see you in the next one.